Continuing on, this example is a good depiction of what happens if enacted tax rates change from one year to the next. You do have to account for that in reporting your deferred tax asset or liability. And then this example, really continuing on for the rest of this learning objective, you have a good example here that shows you the balance sheet approach to ASC 740 and how it looks at the difference between tax basis of assets and liabilities and book basis of assets and liabilities. And it compares those basis numbers from the beginning of the year to the end of the year. So in other words, how did the basis differences change from the beginning of the year to the end of the year? And that helps you determine, or is how you determine what your ultimately what your deferred tax asset and liability amounts are. You can see how you categorize the timing differences as either deductible temporary differences, meaning they're going to be future deductions, or taxable temporary differences, which means they're going to be future increases to tax liabilities. So it shows you beginning and end of the year. So trying to follow through this example and see what makes sense. And then you get the journal entries. You get another situation right here where you compute a current tax expense by figuring out and recording permanent differences and temporary differences in arriving at taxable income. So it's just, I'm not going to go into ad length discussion of all this. You got to see if you can make some of this stuff make sense to yourself, and ask me where you've got questions. Then this last learning objective just has to do with benchmarking. Companies benchmark their tax planning effectiveness against what they've done in previous years to see if they're doing a better job or worse job in in planning. That's it's a big part of a company's financial statements. Income taxes are, and they're trying to constantly reduce their effective tax rate, and so they measure against their own prior performances in that area. And rate reconciliations from one year to the next will show whether a company is effectively managing its effective tax rate. And I think that is about it for this chapter. A little bit of reading toward the end, and then we get into the questions.